Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. If you are after dividend growth companies that have increased their dividend over whatever years, this video is for you. If you are looking for a dividend, companies that slightly have a high yield, is also for you as well. What I'm going to do today is look at 7 companies that have increased their dividends in the month of July. And if you know me, you know that I actually like dividend paying companies, because my goal is, inshallah, at one point, in the future, to be able to retire on dividends as well as rental income. So the passive income from my rental properties as well as my basic dividends is what I'm looking forward to retire on, inshallah, in the long run. And I always focus on different companies in this portfolio, especially because every single company in here, those 25 companies, are all dividend paying companies, but they are in different stages when it comes to their dividends. Some are dividend growth companies, so like Visa and MasterCard and Broadcom and S&P Global. They all have a small yield, less than 1%, and they are dividend growth companies. They increase in that 5, 10, 15, 20% plus. But you also have companies like Rio Tinto, Canadian National Resources, and so on, which are more of a dividend growth, basically companies that are paying high yield right now. But they are also increasing here and there, but they're not as consistent as the others, if you like. So I'm using the money from the dividend companies to buy more dividend growth companies, because I want to use this money when I retire, maybe, God knows, inshallah, whenever that happens. Okay. So yeah, so this really fun video to watch and just basically see how these companies are increasing despite what is happening in the market and so on. If you haven't joined us in the Patreon account, please do so. Send me your portfolios, because I've got now 2 more to do today, and inshallah I think then I'm done with it. So if you've got a portfolio you would like me to look at and give you my honest feedback, okay, go and basically join us in the Patreon account. It will cost you less than £6, and you will get a lot out of it, inshallah. Right, let's get started. We're usually looking for the same things, but this time the difference is we're focusing on the latest increases. And the first company we're looking at today is Cummins. Cummins is one of the companies that I've had in my portfolio for a very, very long time, and it has increased their dividend 10%. When you look at that dividend of 2.25% and the payout ratio only 33%, and the latest increase being 10%, that's absolutely huge. That is for a company that's been around for donkey years. This is really very good. And it has that threshold of 7% that we're normally looking for. 19 years of increasing that dividend. I would not be surprised if this company becomes dividend aristocrat soon. Annually, you get $8, and dividend safety of 98%. So that dividend is safe, is increasing every single year, and it's basically right now what you will get is basically $8 for every share of this company that you own. Profit margin, return on equity, return on invested capital is decent. And when you look at the EPS growth for the next year, we're looking at about 15%, revenue about 6%. But right now seems a little bit expensive according to Morningstar. So we're going to look at fast graph as well, just to make sure that we see where we are. Now, if you bought this stock right now using the normal estimates of that 12, 13%, 6%, 7%, so on, you will be making about 11%. So it still seems undervalued based on that 15, I think it's a 15 PE. There we go. Yeah, it's 15 PE. So based on that 15 PE. But if you look at the normal multiples for these companies, are more or less the same as well. That's that 14 PE. That's where it has been. Now, that again, you're making about $1,000 on the top of your money in the basically next or 10%, let's say, for the next bit in total. So total annualized rate of return, you're making about 4% if you're using normal multiple. If you're using that based on the estimates, which is that at 15 PE, you'll be making about closer to 5% per annum, or total rate is about 11%. So you will be making about 1,100 at the top of your money. Right, let's go back here. And the next one that we're going to look at today is UNP, or Union Pacific Corporation. Union Pacific is now merging with another company in the same sector, and I'm actually excited about that. Let's see how that goes. I don't know if the regulatory will allow them, but let's see how that goes. 130 billion market cap. It has a wide mode, $222 per share right now. 2.5 when it comes to that dividend. Payout ratio only 47%. And latest increase was just 3%. Okay, that's enough. 7% in the last 5 years. That's not bad. I hope they can continue to increase that dividend, maybe 5% or even more. 18 years of increase in that dividend. Another one that's heading towards that dividend aristocrat. $5.52 is what you will get. Safety is 80%. Return on equity, return on invested capital, profit margins is good. EPS expected to grow about 10%, revenue about 4%. This is normally what you expected from these companies anyway, from that 4%, 7% to 10%, and so on. That's what you expect from this type of company when it comes to EPS. Revenue, you're looking about 5% to 7% every single year. Right now, it seems a little bit expensive, but if we go here and have a look at the company using normal multiple, if you bought this stock right now, you'd be making literally nothing. It's about $161 in basically 2 years time. But if you use the normal multiple for this one, you would be making about 50% from now on. So you're about 5,000 top of the 10,000 you've invested initially, so 18% per annum, which is quite nice. So if you use the normal multiple, which is basically about 22 PE, and if we go back here, if we go back to summary, I think, and it will scroll down, we will see the blended PE of about 19 right now. The next one is McKinsey. This is basically one of the companies that I've been looking at for quite some time, but I've never actually seen it cheaper than where it is right now. $710 per share. The dividend is very small, 8% when it comes to the payout ratio, which is very, very low. Look at that latest increase, 16%, 11 years of increase in it, 11% in the last 5 years, which is really good, absolutely amazing. That's really, really good. And the dividend streak of basically 12 years, $3.28 is what you get. 88% when it comes to that dividend safety. Profit margin, return on equity, return on invested capital, it's not the best. I think they must have a more liabilities, like current liabilities, the current assets, because that's why return on equity is not there. When it comes to return on invested capital, 58%. EPS, we're expecting about 13%. Revenue, about 13%. So they're growing nicely, but they seem very expensive right now. And if we look at the fast graph, for example, we can see here that if you bought this stock right now using the estimates, basically you'll be making about 1% on your money. If you were to use the normal multiple for this company, you will be losing about 2%. So it seems sort of and basically fairly valued, slightly undervalued at this point. With the margin of safety, I would definitely say it's not a buy right now, but the dividend growth is absolutely there. Next one is Clorox, company that we have not spoken about for quite some time, and one of the reasons I haven't spoken about this company for quite some time is because it's been quite negative since COVID. I think it's been just very, very negative, but it seems it's coming back again because the growth is actually getting better. So 30% EPS expected to grow, revenue is about 4% and 43% upside from where we are. So it seems very cheap, and the dividend payout ratio is basically only 63%. So that's slightly on the high side. So hopefully they can reduce that. But the dividend itself is about over 4% right now. So that 2% is not the best. Okay, and it wasn't even 2%. I think it was 1.6, so it's just rounded up. So that 1.6 is sort of keeping up with and their dividend aristocrat status. So 3 more years, they will become a dividend king. Right now, they will pay you $4.96. Safety is 70%, which is fine. So anything above 61% is safe. And looking at fast graph, as we can see here, there's about 3% upside from where we are. So you want 10,000 will become $10,326, and by the time we get to 2028, if you use the normal multiple for this one, it seems very cheap. So 75% upside from where we are, which is about 17,581 of that initial 10,000 investment. So if you use that, basically it seems so you can go in between if you like, and just basically, if you're interested in the stock, do a little bit more research. If you're happy with it, you can give yourself another 10 to 20% up, sort of a margin of safety if that's what you want. One that I really would have loved to own for a long time is Illinois Toolworks. This is a great company, honestly. 2.6% when it comes to dividend yield, payout ratio only 59%. Latest increase was 7%, the 5-year growth rate of 7%. So it met the criteria that I was looking for, but it has always been too expensive for me. 53 years of increasing that dividend, so another dividend king. Safety was at 81%. Everything else when it comes to profitability is really good. It's probably one of the best out there. And if we go here and type this, let's see what basically fast graph thinks. And if you bought this stock right now, you'll be losing about 22% of your money, or you would have 7,700 left of that 10,000 initial investment. If we use the normal multiple for this one, you would be making about 26%, so about $12,654 per shares shares. Total, that's basically what you will have. I can't even speak. So yeah, your total will be about $12,654. Right, so that's basically the next one. And let's go back here. Centus is another one that's been on my radar for quite some time. Really great company. Dividend is basically yield is very low, 35% when it comes to the payout ratio, 15% when it comes to that dividend increase, which is basically they've done this in July. 5-year growth rate of 20%, dividend streak of 43 years of increase in that dividend. Annually you get $1.80. Safety 97%. Profit side of things, profitability side of things, in terms of how effective the management is, probably one of the best out there. They expected to grow the earnings about 10%, revenue about 7%, but it seems very expensive right now. And as you can see here, I don't even need to show you anything. It seems very expensive. You will be losing about almost 6,000 of your money if you bought it based on the estimates. If you use the normal multiples as well, it's basically flat, so nothing to worry, basically talk about here. I think that 24% is probably right, and I would still give it another 10% or so. The next one is a company that I think Warren Buffett owns. I think this one, I think he's in his portfolio. 58 billion market cap, white mode, 71% when it $71 per share right now. Just a dividend yield of just 1%. Payout ratio only 24%, which is nice. 6% when it comes to that latest increase. The 5-year growth rate 11%, which is really good. They've increased this dividend for the last 5 years. You'll get 72 cents for every share of this company that you own. Safety is 70%. Profitability is not the best here, but the growth side of it, EPS expected to grow about 17%, which is really nice. And revenue is just 4% and 3% basically downside from where we are right now. If you're still here and you're enjoying the video, please like this, and of course the video, subscribe to the channel as well, and let me know if you have any questions. Now if we look at the estimates moving forward for this company, if you're using the estimates, it's about 4% downside from where we are. If you use the normal multiple for this, which is what the market likes to trade this company, you'll be making about 10% on your money every single year. So you will have about 12 for the next 2 years. Basically you will have $12,544. So that's the 7 companies I wanted to share with you guys. This doesn't mean go and buy them. This means just do your research, find out if these companies fit into your portfolios. Like I said to you, I do own the first 2 here, and I'll show you exactly how many shares of these companies I own. The one I would really love to add to the portfolio is this one, but it's always seemed very expensive because it meets my criteria of that 7%, if you like. They've increased that dividend for quite some time. The safe profitability is absolutely amazing, and they are growing that roughly basically what I expected from an industrial company. So it missed my criteria, but it's been very expensive. That's why I wouldn't touch this. But these 2 are the 2 that I own, and I'll show you quickly if I can find them. So Cummins is here. As you can see, I'm up about 63%. I've recently trimmed here. My average price for this company is $225. Okay. The other one, the Union Pacific, there we go. So I'm up about 5% on this one. It's been fluctuating up and down. I would love to buy more of this company. My average price for this one is $206 per share, and right now, as you can see, it's $222. So yeah, that's the companies that I own. That's basically the 2 I own out of this. And from Shariah-compliant side of things, I'm going to show you that quickly so you have an idea. You can pause the video and have a look at that. Nothing to worry about apart from Union Pacific, which has a slightly the high interest bearing debt. Other than that, they are absolutely fine. So I hope you're enjoying the content. I hope you are getting something out of these videos. And like I've always said to you, this is a bit more entertainment for me, but at the same time, you just need to do your own research. And if you haven't joined us on the Patreon account, please do so. It will cost you about £6 basically a month, and you'll get a lot out of it, inshallah. Have a wonderful day. Assalamu Alaikum.